Technical analysis. Some people love it, some people hate it, but at the end of the day, it is one of the most popular approaches to investing. At the very least, you need to cover the basics. Today, I will talk about what technical analysis actually is, why it works, why people criticize it, and why I personally use it. If you're interested in videos like these, please like and subscribe. Now, let's get started. Stock charts have mesmerized people around the world over the last few decades. To a lot of them, the charts are these mysterious artifacts which are only mastered by the elite Wall Street pros and traders. They think the charts are hard, even impossible to learn, but that is simply not the case. Charts can be confusing, but you can learn to read them, and technical analysis helps you do that. In a nutshell, technical analysis is about analyzing statistical data from trading activity to identify trading opportunities using patterns, price trends, and other technical indicators. It enables you to use past trading activity and price changes to get an idea of how the price may change in the future, and it can be applied to virtually anything. It doesn't matter if it's a stock, bond, commodity, or currency. Generally, there are three main assumptions that technical analysis makes. 1. The markets are efficient, so there is no point in analyzing the stock, security, commodity. Instead, you should only analyze the price. 2. Prices tend to move in trends. And 3. History tends to repeat itself due to market psychology. Immediately, you probably notice two things. First, it is about analyzing the trading activity, not the underlying stock or security. Technical analysis does not involve anything to do with revenue, net earnings, whether the company has debt, who is actually managing the company, none of that, nada. This type of thinking, the efficient market hypothesis, has largely been disproved. So, critics say that using it immediately makes your analysis faulty. Secondly, technical analysis looks at past activity. If you have ever used an online trading platform or looked at charts and analysis, you have likely seen the disclaimer, past performance is not indicative of future performance. Why is that? Well, just because a company used to do well before does not mean that it will continue to do well. Also, you often get unexpected events, whether they are company related or related to the broader economy. You get some weird trading activities that completely disregard previous trading activity, structures, patterns, etc. Predicting the future based on the past is simply not a smart thing to do, and that is why technical analysis has a lot of critics. However, I think that this is unjustified to a large extent. First of all, there is something known as the green lumber fallacy. Essentially, Michael Lewis, one of my favorite authors, wrote about one of the most successful traders to ever trade green lumber. He thought that the lumber was simply painted green, when in fact it was actually freshly cut wood, meaning he had absolutely no clue what he was trading. And in his book Anti-Fragile, Nassim Taleb mentions a similar case about a trader who would make a fortune trading the Swiss franc, but at the same time had no clue where Switzerland even was. Although these are just two examples, we can see that company or product knowledge is not always related to the successful trading. Plus, a lot of critics only learn a little bit about technical analysis and fail to truly understand it. They fail to manage their expectations properly. They fail to understand that technical analysis is all about probabilities. All of the indicators, all of the strategies only work some of the time, not always. If you see anyone who says that a trading strategy works 100% of the time, they are trying to scam you. There is no such thing. The most successful patterns work maybe 70 or 80% of the time, not always. Plus, patterns, indicators, trend lines, oscillators, all of these must be used together to improve your chances of spotting a good trade. Never use a single indicator by themselves. That's a recipe for disaster. The more indicators, patterns, and trend lines align, the higher confidence you can have in the trade. Also, all of these need to be taken in a context. You need to be familiar with what the market is doing right now. Is it going up? Is it going down? What is the long-term trend? What is the short-term trend? You also need to be familiar with the sector. You need to be familiar with the company's historical performance. A lot of critics fail to consider this, but as you can see, there is a lot that you need to be aware of and monitoring to be able to make prudent decisions using technical analysis. Finally, some forms of technical analysis have been used for literally over 100 years, and they are still relevant, which just shows you that there is something to technical analysis. So, What is my personal take on technical analysis? Well, I try to keep it simple. I think that if your stock chart starts looking like drawing or a painting, then you've probably overdone it. I like to stick to only 3 indicators per stock, and to be honest, you don't really need more. My favorite ones are the simplest ones: the 50-day and 200-day moving average, RSI or Relative Strength Index, and volume average. My approach tends to lean towards medium or long-term investing, so I use technical analysis in addition to fundamental analysis, not by itself, and I would actually recommend that you do that too. It should help you make decisions, it should not make them for you. Technical analysis is great to find good entry and exit opportunities, or, to put it in simple terms, to find out when a stock is on a discount, and to find out when is the best time to sell. However, it will not tell you whether a company is good or not. Some people swear by technical analysis, and that can be good in situations where the fundamentals are blurred and hard to determine, like for example with cryptocurrencies or forex. But generally, technical analysis works best when used alongside fundamental analysis. It is definitely something to add to your arsenal of trading knowledge, and it can really help you make better decisions. Plus, there is a massive amount of both professional and retail investors who have no clue about technical analysis, so even spending just a few hours on it can give you a massive advantage in the markets. Also, technical analysis is great for navigating the markets in the short term, but as I mentioned before, you need to learn a lot about it and have a lot of confidence in your skills before you do that. Now, if you're still skeptical about technical analysis and you're not sure whether you want to use it, don't worry. A lot of the most successful investors strongly oppose technical analysis and prefer to look at the fundamentals instead. Some of these include Warren Buffett, Charlie Munger, Peter Lynch. So, rest assured, you can be perfectly successful without any sort of technical analysis. However, if you do decide to use it, make sure that you learn about it. Make sure that you understand it well. I will be posting more tutorials on technical analysis shortly, so make sure you subscribe and click the bell icon to get notified when they get released. Also, please like this video and comment below with the one thing that you've learned from this to guarantee that you will remember it. Thank you for watching and stay tuned.